Well, good morning, everybody. My name is Matthew Mims, and on behalf of Devon Funds and the Investment Store, I'm delighted to welcome you to our latest and first investment briefing of 2017. So in today's update, Devon portfolio managers Tama, Willis and Nick Dravitzki will provide an overview of the current macro environment, discuss some topical news from the current reporting season, and comment on recent performance and provide some attribution for the various Devon funds. So the session's going to last for approximately 15 minutes, and we will leave a few moments at the end for any questions that you may have, and please do send them in as we go along using the questions box. And thanks also to those who have sent questions in prior. As ever, and please note that the information in this presentation is of a general nature and should not be taken as financial advice to purchase or sell a financial product. So on that note, I'd now like to pass you over to Tama, who is going to kick off the presentation.
Thanks, Matt, and I'm Tama. I run the Australian and Trans-Tasman funds at Devon. I'd start with slide 2, which has a chart showing global macro conditions and GDP growth. And whilst certainly in the last 6 months geopolitics have dominated the press and investment concerns, when you look at macro data that has been coming out over that period, it's been generally stronger. We've seen UK survive Brexit. In fact, growth has been reasonably resilient. Chinese GDP growth has been picking up. US and European manufacturing data has been stronger. So whilst all of that has been going on, we've seen macroeconomic data improving globally, commodities picking up. And I think that helps explain some of the performance across certain markets. If we move on to slide 3, looking across the Tasman, as you know, we make trips across to Australia every few weeks, and we'll be over there again in about a week, reviewing a company's post-reporting season. But sentiment across the economy has picked up slightly, I'd say, over the last 6 months. And the principal reasons for that, if we run through a number of them, we have seen the terms of trade in Australia pick up quite significantly, and that's been reflecting some of the high commodity prices coming through. The 2 biggest exports for Australia, or the 3, in fact, now that the gas production is picking up, are iron ore, coal, and gas, LNG gas. So those 3 commodities, you've seen export volumes picking up, but you've also seen prices up quite strongly. So that's improved in sentiment. We've seen this has also helped business confidence, which you'll see in the chart to the right has also picked up quite strongly in recent months. The Sydney and Melbourne housing markets have been reasonably strong over that period. And the stock market has been performing reasonably well, which again has helped sentiment. One thing I would point out on the left-hand side is consumer sentiment still pretty mixed in Australia, and I think whilst you have some of these indicators from the economy at the margin improving, consumers have seen limited wage growth, so wage inflation is still very low, and whilst house prices have been going up, we've also seen some mortgage rates as funding costs pick up due to global bond yields lifting. You've seen funding costs for the Australian banks pick up, and you've seen loan mortgage rates for investor lending and for general borrowing picking up. So that's constrained consumer sentiment. But on the whole, I'd say a slightly improved sentiment across the Australian economy over the last 6 months. Looking on to slide 4, now we are in the midst of reporting season at the moment in both the Australian and New Zealand markets. In Australia, we're probably about 25% of the way through. We've had over 60 companies report. So far, around 60% of those companies have their share prices have increased on day one, and 40% have gone down. So that suggests that the reporting season so far versus previous years, that's a slightly better ratio of improvement versus decline. So results season a little bit better than expected so far, and over the next 5 to 6 days in Australia we'll have probably more than half of the balance of the companies that we're reporting in Australia. Ahead of reporting season, so the chart on the left, you'll see that in FY17 in the ASX 200 you've seen analysts upgrading estimates, which is quite unusual when you look over the last 4 to 5 certainly the last decade, you've seen generally earnings being downgraded, and that's principally the result of stronger resources earnings. And you look on the chart to the right, you'll see that the ASX 200 earnings growth forecast for 2017 of about 14%, over half of that is the resources contribution. And that reflects the very strong increase in commodity prices that we're seeing and the upgrades to earnings estimates that we're seeing coming through. To give you an example, so far in reporting season, you've had Rio Tinto report where they beat estimates on cost savings and strong received pricing. They return capital. Resources are around 20% of the Australian market. In terms of the banks, you've also seen slightly better than expected results from the banks on benign bad debt charges. If you look at this next chart, CBA reported its result yesterday, and what this shows is that the arrears that they've seen over the last 6 months have declined across the key metrics, and what that doesn't show you actually is which categories those lines refer to. But the top chart is I believe credit cards, the middle chart is consumer loans, and the bottom is mortgage arrears. So across the group, generally declining, and which has meant that bad debt charges have been very benign and in fact lower than expected, which has driven a slightly better earnings performance from the banks. You've also seen cost growth has been very well controlled. So the banks have rallied quite hard over the last 3 months and are reflecting a lot of this improvement in the conditions. Near-term conditions. Commodities, just briefly touch on those. Obviously we've seen the chart on the left shows performance of key commodities over the last 10 years. You've seen, if you look at the key commodities there, thermal coal was very strong earlier this year as China cut coal production quite aggressively. They've relaxed the cuts there, and you've seen coal prices fall back, but in the meantime iron ore has picked up very strongly towards $90 a tonne. And that really reflects very strong Chinese credit growth, some supply issues, and slightly better demand outlook in China. Over the next 12 months, I'd expect the iron ore price to pull back like we've seen in coal, but at the moment you're seeing some positive trends in China. In terms of the mining companies, they're still come upgrade. If you look on the chart on the right, that's using spot commodity prices. Most of that is iron ore, so is very iron ore is obviously the key one there. Across Trans-Tasman Australian Fund, we have exposure to quite a number of those companies, including BHP, Rio, Woodside Oil Search, Sandfire, and Horizon. So we have quite reasonable exposure to a number of the thematics there. With that, I'll pass you over to Nick and look forward to any questions after.
Thanks, Tama. Good morning, everybody. As Tama mentioned, we are in the midst of reporting season, so all the companies with a June or a December year end have to report either their full year or half year numbers by the end of February. So the last 2 to 3 weeks of February is a very busy time. I'll just make some comments on the New Zealand reporting season to start with. So the table on the left there is a market-wide forecast for revenue and earnings. That one's put out by one of the brokers, Forsyth Barr. And as you can see, the expectations are reasonably modest but positive. And in fact, if you look at the chart on the right where you have actuals going back, you can see that there has been consistently good earnings growth over half and full year numbers over recent years. And in fact, the relatively modest forecast numbers do, on the face of it, present some chance of outperformance. So far we've had a few of the large caps reporting. Contact reported earlier this week, that result was in line, but it didn't have any blow-ups, which is quite nice for Contact, so that was reasonably well received. Sky City reported last week. They had a very poor trading update after the first quarter, but the second quarter saw the Auckland casino gaming turn around quite a lot, and so that result ended up being quite well received by the market, and the stock rallied 6% on the day. That's despite significant weakness across its Australian businesses and its international business, which has seen revenues come back very strongly, as have many of its Australian counterparts following the issue with Crown Casino employees being arrested in China. Today we've had Spark, and I haven't seen how the market's opened on Spark, but broadly the result looked fairly in line. Probably the most interesting result yesterday was A2 Milk, which showed spectacular growth. But it's a good reminder of how the market, a good illustration of how what matters from the market's point of view is what expectations are, and they provided a very strong trading update at their AGM towards the end of last year. And while this result was extremely good, much of it was in the price, and the stock ended up being flat on the day. So broadly, reporting season still early days, but looking okay so far. Now, in terms of the opportunity of those companies being able to outperform those expectations, it's worth emphasising that the New Zealand economy continues to bowl along at a reasonably fair rate, and some of the drivers that have been pushing GDP along continue to be quite powerful. So if you look at slide 8, just worth reminding ourselves how strongly tourism has grown, annualising at 3.5 million in December numbers. And the key drivers there over recent years have been strong growth out of Australia, but particularly strong growth out of China. 2016 over 15, it was up 15%. And the US, actually our third largest tourist market, has grown 20% in the last year. So a lot more capacity from airlines coming on, stimulating a lot of demand. You've seen that in Auckland airport traffic numbers, and that's really driving a very strong tourism contribution. So it's now our largest export sector. Key to overall GDP growth has been the increase in migration, and that's on the right-hand side of slide 8. And it's worth pointing out that while much of it is driven by fewer departures, and that's largely driven by weaker job expectations in the Australian economy, and so that trans-Tasman migration has actually turned positive, as in there are more permanent residents arriving from Australia into New Zealand than vice versa. That isn't New Zealand citizens. There's still more New Zealand citizens going to Australia than coming home. But the mix of a large number coming home, fewer leaving, and other citizens moving from Australia to New Zealand have turned that positive. If you look at how that actually breaks down, the vast majority of Australian residents moving back to New Zealand are New Zealanders, around about 75-80% of it, and most of those who are not Australian citizens are children, are not New Zealand citizens, are children of New Zealand citizens. So it mainly reflects New Zealanders coming home. But it's worth mentioning that it is not just fewer departures and not just that trans-Tasman market that has driven migration. As you can see, arrivals have risen strongly. A large part of that has been student growth, and that looks like moderating, but there has nevertheless been good growth across other categories and work visa categories. And so what that's the impact of that has been to drive GDP growth. It's good for company earnings on a per capita GDP basis. It means that our GDP growth has been more or less flat, but it has driven economic activity that's good for company earnings. Turning over to slide 9, worth reiterating again that the construction boom that's going on is very significant. And in fact, on the data going back to 1989, it is the largest amount of total building activity ever happening in New Zealand at the moment. And interestingly, we all hear stories of how construction prices are going through the roof, and construction is a material contributor to employment and to the economy. But despite that, we're still not seeing much in the way of inflation, and this really is the key issue to economic growth in New Zealand at the moment, is with interest rates remaining so low, and they're remaining so low because inflation, despite a spike in Q4 off a pretty low base, we're still not really seeing inflation come through, and that presents the big risk, of course, to the New Zealand economy. If we do start to see inflation come through, and the big risk there relates to prices rising, particularly Chinese producer price inflation, which has hit 6% in January. If that starts to feed through to CPI and we start to import inflation and we need to increase interest rates, then clearly the momentum in the economy will be impacted by that. There are all sorts of other risks, of course. Trump is very much a black box in terms of having any idea what impact he will have. China, while the headline numbers are very good, growth is very much debt fueled and risks are ever present there. But nevertheless, at the moment, we do have good, strong momentum in the economy, and that's what's driving some of these earnings numbers coming out of listed corporates. Just turning to the last comments I'd make, just slide 10 on performance. The last quarter has been tough across our funds, and largely this has reflected the strength of resource companies in the Australian index. All of these funds invest either significantly or entirely in Australia, and broadly we've been underweight resources as some funds have owned a reasonable proportion, but not as much as the market, and consequently that very strong performance from those commodity prices feeding through to earnings and being re-rated in share prices has caused these funds to underperform. Also, we've broadly been modestly underweight banks. We did invest in banks significantly towards the end of last year and around October last year, as we took the view that bad debts and the capital situation was some of those risks were dissipating in the near term. But broadly we have remained slightly underweight, and the performance has also hit. Over a medium to long term frame, our performance numbers are very good, but in that shorter period there has been some underperformance. We do like the stocks we own, and we do see some very interesting opportunities out there at the moment. Some of the volatility in markets in recent years, in recent months, has seen some really good companies be significantly sold off, and we think there is some excellent opportunities out there, so we feel positive looking forward. So I'll leave it there. I'll hand it back to Matt, who I believe will have some questions for us. Thank you.
Thanks, Nick and Tama. So we've got a few questions. We'll maybe just kick off with one on the alpha strategy. The alpha strategy has been running quite a lot of cash over the last 12 months or so. Is there a catalyst for the alpha strategy to be more fully invested?
Thanks, Matt. The whole investment process behind the alpha strategy is that it is there to reflect our best ideas, and running cash has reflected the fact that in a market that is both in Australia and New Zealand quite expensive, so overall PE on the New Zealand market between 19 and 20, on Australia around 17, it's been difficult to find great ideas. While we have had some, we haven't had enough to go completely be completely invested across alpha. I have added a couple of positions to alpha in recent times, and so the fund is currently about 30% cash, but the driver will be, as always, do we have sufficient conviction in ideas to move it? And as I mentioned, I think there are some very good interesting ideas that we're working on at the moment, and so there is every chance that stock weighting will move higher if we reach sufficient conviction on those ideas.
Just a question here on relative valuations between Australia and New Zealand. I don't know if you can make a comment on that.
Just as mentioned, New Zealand market is slightly more expensive, or materially more expensive on a PE basis than Australia, but both markets are at least moderately, if not significantly, more expensive than the historical averages at the moment. Do you have any comments to make on that, Tama?
So I agree with Nick. You've seen the Australian market re-rate in recent months, but equally you have seen resource earnings being upgraded, and there is a possibility that we see further upgrades to the resource sector, so that the ASX earnings growth this year of about 13% does look reasonably well underpinned at this stage.
Just a question here on recent lack of new IPOs and listings on the NZX.
Indeed, there has been very few. At this time of year, you wouldn't expect much to be happening because start of the year, and then we have reporting season. So it'll be interesting to see what comes out in March and April. There's certainly discussion of one or two, but last year was very disappointing in terms of IPOs. I'm trying to remember. I think there was one, but I'm struggling to recall what it was. And I think, unfortunately, that partly that reflects some of the very disappointing performance from some of the IPOs that came earlier. If you look at Intueri and Wynyard, SLI, and some of these listings that were made have unfortunately not performed very well, and that always makes it a bit more difficult. But we would love to see more, and we'd love to see good companies coming to market. So we're certainly very keen to see that increase and improve.
So we'll just finish with one final question, and obviously not forgetting Devon's approach as a bottom-up stock picker. Maybe just a couple of examples of higher conviction views currently within the portfolios.
Thanks, Matt. So we retain some of the largest positions. We have in GTN, which over the last quarter still up strongly since the IPO, so it listed about $1.90 a share, increased to around $3.80, and it's currently trading around $2.70, and that's part of the underperformance over the last quarter. That's still a very high conviction position. We have the result coming up next week. They have made an investment in the US, which has given them 50% market share in the US radio market for traffic reports, and whilst it'll be loss-making in the next 6 months, if you look at where the Australian business is, they currently make about $50 million of EBITDA out of Australia, and the US business is currently 4 or 5 times bigger than that. The US market is 10 to 15 times bigger than the Australian market, so that represents a major opportunity for them, and the market's taking a wait and see approach, but we think that as they deliver on that US potential, there is a lot of upside to that name. We still have a Invista as well. We still like that business a lot. We again have the result over the next week. They have been growing very strongly. They've been investing a lot in the business as well, so we'd expect revenue growth is going to be, revenues will be up something like $25 to $30 million this year, but they're also putting $20 to $25 million of cost in as they build out the offering to the studios, into this Chinese joint venture they have with Tencent affiliates. So there's all these different things going on in the business which are quite exciting for the future, and we'll find out more in the next week or so. Nick, do you have any additions to that?
I'd certainly concur with Tama on both GTN and Vista. A different type of stock that we have high conviction in is Contact Energy, which reported, as I mentioned earlier this week. Not an exciting stock by any means, but this is a business that has extremely high free cash flow, doesn't have any need to be building any more generation in the foreseeable future, and is currently going through a period of paying down some debt, but in the result they made the comment that they will be looking to be within their target by the end of the financial year, at which point they can look to start redirecting some of that free cash flow to shareholders as distributions. So very defensive business, not particularly exciting top-line growth, but fantastic cash generator which shareholders stand to benefit from. The key risk around those stocks, of course, is Tiwai, and the potential closure of that smelter. With aluminium prices where they are, that smelter is clearly significantly cash positive. It looks like Rio are in the process of trying to sell it. If they do successfully sell it along with some of their other aluminium assets, then it would be very unlikely that a purchaser would be looking to close it down. So it feels like the Tiwai risk is diminished significantly, and therefore it's quite a different type of stock or story than GTN or Vista, but still an attractive high conviction position across our funds.
Okay, well, we've probably used up all our time, so just to wrap up, many thanks to you all for taking the time to log in today, and thanks also to Tama and Nick for preparing the material and presenting, etc. We will, of course, send a follow-up note, including a copy of the slides and a recording of today's session, but if you do have any further questions, feel free to contact either myself or Devon direct. Thanks very much.